topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio, its employees, or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, good morning. Great Monday morning, and continuing on from a program we just finished with Ask the Experts and Steve-O. Great program. We were talking about IRS problems and relief and solutions. And do you have to talk to the IRS if you hire us? All those great things that we were talking about there on Ask the Experts. So you can go find Ask the Experts and see their podcasts, iHeart and YouTube and so forth, Spotify. I think they're on all the major networks out here. But right here on Tax Talk for You, you can go over to Tax Talk, the number 4 letter U.com. Follow us over there. Never miss an episode. You can do that over on Facebook as well. We're here to help you. Today, we're talking about selling your business. Man, as a small business owner, you envision turning your company, your practice, your storefront into, maybe the next Walmart or, the next large search firm out there or practice. And, you've built this business and now you're dreaming of maybe retirement, maybe stepping away, and you're looking for that sizable payout, selling your business. And, so you're going to be counting on, that money for the next stage of your life, retirement, travel. Maybe it's a second career, or maybe it's doing the next business you want to get into. So you've got to take, what are all the tax implications in selling this business? Especially maybe you're getting lump sum, or maybe you're getting monthly or annual payments on this thing. You're owner financing it. And so, what is your tax liability? What's the best way of selling your business? How are you going to reduce these God-forsaken taxes that you're going to have to pay? I mean, you've built this business and now you're getting this sizable payout in selling your business. You got to think about this. So you've built this business, you sell it for, let's say, $1 million. What's the tax implications on there? And it all depends on how you're structured, how you're doing the deal, how the sale is going to go through, and then what's the taxability on all of this. So, let's start with, hey, if you just were selling this business and everything was ordinary income, you could be paying up to 37% tax on this. Or maybe even adding that 2.5% for Medicare on there. So now you're at 39.5%. Then you add state income taxes on this. Wow. What are you left with at the end of the day? Maybe you're paying a broker fee as well. Let's say 10%. Now what do? All these things are going to impact your bottom line. All these things are going to say to you is, how much am I going to be left with at the end of the day? How can we avoid this much in tax? Is this the right time to even sell my business? And we had our first question here today. Ernie, what if you need time to get things in business going? How would you know is it a good time to sell? Well, if you need time to get things going, you don't have to be in a rush to sell your business. We're talking today that, hey, you're at the point of wanting to sell your business. Maybe you're tired of doing what you do, or you need a new challenge in your life. Maybe you've gotten to the point where, hey, it's not a challenge anymore and you want to move and do something different. Maybe you just want to retire and you don't want to be working 40, 60, 80 hours a week, keeping your business going and doing the things you need to do in business. Those are decisions you have to make, personal decisions. Sometimes it's somebody who just walked in the door and made you an offer that you just couldn't refuse. What if that happens? Somebody asked me one day, would you sell? Well, if somebody came in and offered the right price, everything's for sale. Almost everything, wife and kids excluded. But the building that we're in, if somebody came in and offered us a price I couldn't refuse, I would sell the building that we own. Somebody asked about our ranch. Everything's for sale at the right price. Somebody offers you an unbelievable amount of money for it. Is it going to be, what you want and what you need to walk away, and then maybe replace it with something different, or move on to something else, or, hey, you just wanting to retire and go. Arnold's asking, if you're thinking about selling and going into something different, do you need to sell or shut down, or can you just restructure and keep the tax identification of the current business? Well, Arnold, kind of depends on how you're selling. I mean, if you're just going to shut down and just say, hey, I don't care, it doesn't matter, then you can just shut down and walk away and close the business down. If you're selling the assets of the business, okay, now we're going to talk about how you structure sales and the best tax advantages, how you do it. But if you decide you're going to sell the assets of the business and keep the business, let's say you own Maverick Investments and you sell everything off, you can continue to use that, maybe change the name if you wanted to, and keep that entity if you wanted to do that. But you may want to just restart and do something different with a different name, your choice that's out there. So you can do things that restructure the business and keep your employer identification number and keep the current business. But if that's the case, then you need to sit down and talk to your tax person, your lawyer, and make sure it makes all sense for you. Now, you got that offer that you're going to sell your business, and you're going to accept this offer. What's the best structure for you in this business? Because the total amount of tax that you're going to pay depends on how that deal is structured, the legal classification of your entity, and how the purchase price is allocated across the assets that you got out there. So, you've got to look at it this way. If you're looking at the lowest possible tax, you're looking at structuring this as a pure stock sale. So if you've got an LLC, you've got a Inc., you go to sell the company and the company shares. Now we're going to make this simple and easy. You're then just selling the ownership equity. It is strictly capital gains, anywhere from 15 to 20%. In this structure, if you're selling, is favored by you. Why? Because you're selling stock, just like you're selling Exxon stock, or you're selling McDonald's stock, or you're selling any other stock you invest in that's publicly traded out there. You're selling your interest in the company. That's it. they take over the company. So, if you were selling Joe's Widgets Inc. or Joe's Widgets LLC, and you sell the shares, this is going to achieve the lowest possible tax out there, because you're only going to have capital gains tax on the sale of the interest of the business. Now, that's favored only by sellers. Okay. Buyers are not looking to do that, because when a buyer buys your business, they buy a lot more of the liabilities and everything else the company has done over the past however many years your company has been in existence. And they get no depreciation except for the depreciation left on the assets that are in the business. So it makes a huge difference to a buyer on which way they're going to go. Now, remember, tax consequences for you as the seller, selling the stock, selling the membership interest in your LLC is the preferred, because it does achieve the lowest possible tax on the business. And that's what you as a seller are looking for. So, you have to look at how this is going to be structured, not just from your standpoint, but how the buyer is going to be looking for at it as well. Now, we're going to take a short break. When we come back, we're going to talk about the implications of buying stock as a buyer and how it may influence how this transaction is going to go as well. We'll do that right after this.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We had a couple of good questions come in right before the break. Pam, you were asking a question about starting a new business, not knowing what kind of income or revenues you're going to have. Should you start it as an LLC or corporation? Hey, we did a great show last week at Tax Talk for You about starting a new business and things you need to know about that. So if you go to taxtalk, the number 4 letter U.com, you can go over there and see and watch the podcast from last week. And, you can also go to iHeart and Spotify and even YouTube and see the shows as well. Again, that's Tax Talk, the number 4 letter U.com, and go find last week's episode and see everything about starting a new business as well. But thank you for listening, and make sure you get over there and see some of the other shows that we've got as well. Mandy was asking, do private companies have stocks such as an LLC? So yes, when you set up your company and you're going through and doing your articles of incorporation, they're going to ask you how many shares of stock or your membership interest as an LLC. Yes, they consider it to be stock that should be issued. If you're going through a lawyer, they would typically give you a big corporate book with stock shares and everything in it. If you're an LLC, they usually give you a corporate book and give you what is considered shares of membership interest in the LLC. And those are what you sell, and they take over your business. Now, as a buyer, as we were talking about before the break, so there are some negative things that come with a stock sale or stock purchase if you're the buyer. So you, as the owner selling it, wants to sell the shares because of the lower rate. You, as a buyer, you usually dislike pure stock sales because you inherit all historical liabilities and lose the ability to write off asset depreciation. Now, if there's still some depreciation in the assets, you can write it off. But when you're buying the shares, you're buying the company. When you start buying the assets of the business, you now have a depreciable or amortizable asset out there, which we're going to go through. So one of the big things we tell people if we're working with the buyer is you want to do a transcript analysis on the company you're buying so that you can look to see, do they have any liabilities with the IRS, such as payroll liabilities? You don't want to inherit those kind of liabilities. Have they filed all their tax returns? Is there any penalties that is being assessed against the company? Because these are things that you're going to inherit. Do they have an accounts payable? Have they paid all their debt? Because if they haven't paid their debt, you would be subject to paying that debt. You could put some money in escrow just in case you have some of these things, but sometimes that seller doesn't want that and they want everything up front. So you kind of got to watch what you're doing. Now, the other type that you have is an asset purchase. Now, asset purchase is actually split by assets. So the seller may have some capital gains mixed with some ordinary income. As a buyer, you're going to buy the assets, be able to depreciate or amortize the goodwill or amortize some of the other assets that you're out there, and then depreciating the other assets that you're doing. So if you bought a trucking company and had trucks, you'd put a price for each of the trucks that you were purchasing so that you'd be able to depreciate those trucks in this purchase. If it just has a client list, then it would be basically goodwill and you'd be amortizing it. So there's a difference out there. Now, as the owner of the business who was selling, you would have potentially capital gains on some assets that you're selling, but then you would have ordinary income on much of the assets that you're selling. And therefore, you could be paying the higher tax rate based on what your tax bracket is. And that means you could be paying up to 37% out there. So you as a seller are selling individual components of the business, equipment, inventory, goodwill. So those are the things that you're looking to do, and then you're going to have the higher tax rate out there. So, and then, wow, a lot of things to consider. You got to factor in the type of entity that you have. So your current business structure can alter how the cash proceeds are legally processed and taxed. So sole proprietorships, LLCs, these are pass-through entities, and the sale is automatically treated as an asset sale, and taxes flow directly onto your personal tax return via IRS Schedule C and IRS 4797. Now that's saying that your LLC is a single member LLC out there and not a partnership or S Corp. Your S Corporation has pass-through treatment, but you have the flexibility to execute a stock sale or utilize a Section 338 H10 election, which this election treats a stock sale as an asset sale for tax purposes, allowing you to negotiate a higher purchase price in exchange for giving the buyer a better tax break. out there. So there are ways of going through and doing that if you're going to do a stock sale. But if you're trying to get away with the stock sale to lower your taxes, that Section 338 H10 election should not be executed. So something to consider. If you're a C Corp, you're going to have double taxation. So if a C Corp, you have an asset sale, the corporation is going to pay that 21% federal income tax on the profit first. Then you're going to pay personal capital gains taxes when distributing the remaining cash to yourself. But if you sell the stock, again, that avoids this corporate level of tax, and you're just taxed for the sale of stock. So it makes it very, very complicated as you're going through and doing this, is what's going to be the right way for me in doing this sale. So it's partly art of negotiation. A lot of times when you're doing a stock sale, you're going to get a little lower price because the buyer loses that depreciation, amortization of goodwill and stuff that they cannot get if they just buy the stock, and picking up the inherent liabilities of the company that could be outstanding via the stock sale. So you may have to weigh out what's best for you. So we sold a company many years back, and we had to sit down and weigh out what was going to be the right way to do it. They weren't offering a high enough price, so we preferred stock sale versus asset sale because it would get us down to the right value. When we sat down and looked at whether we would want to sell the company, the numbers weren't right, so we didn't want to sell. The numbers just wouldn't work. So, that's the things you've got to sit down and look at as a business owner to decide, hey, is this the right way to go? And it's not the gross number that makes a difference. It is the net number after tax that becomes the most important number for you. So if you're going to be in that 37% tax bracket, and let's just say you have a broker at 12%, well, now you're at, roughly net of 45%. I know that doesn't add up. We're lowering the taxes because of the percentage we're paying the broker, so that we're not getting taxed on all of it. And now, hey, is this right amount to be left with? So, if it was $1 million and you're, out of that $1 million, you're going to pay the highest taxes and everything on it, and you're left with $550,000. Is that enough money really for selling the business? Well, it may not be. And if that's not enough money, then you go back to the drawing board and say, no, this isn't the number that I need to go through and do this. Or maybe, hey, we turn this into a stock sale so that I'm only paying maybe that 20 or so percent out there on it, plus the broker commissions. And so that maybe makes more sense to you than selling the assets of the business. So depending on the price, it's going to be an art of negotiation, in this asset sale. So, you and the buyer, you've got to sit down and discuss, hey, if it's an asset sale, you've got to come up with how much is goodwill and intangibles. You get tax treatment. How much is going for inventory or stock and trade? How much is fully depreciated equipment going to be going for? Is accounts receivable? How much they giving you for the accounts receivable that's out there? So all these things you're going to want to negotiate. You're going to want to maximize the amount that goes into goodwill to use the lower capital gains tax rate on this. So, those are the kind of things that you're going to want to negotiate in the sale of a business so that you can lower your tax burden on this sale. So you're proud, you've made a lot of money in this business, you have great revenues, you have great net income, your earnings before income tax is really strong, and you're going to get a good payout. And now you got to look at, you're looking at the tax implications on this, and what am I going to net after this is all done? So you got to have a good tax preparer that knows what they're doing, so that when you're going through this negotiation period, that you can get this down to the right amount, so that you can deduct it the right way and decrease the tax burden on yourself. And as a buyer, you're wanting to increase your amortization and your depreciation on the purchase of the assets as well. So then you also, if you're in one of those dreadful states that have a state income tax, you could have additional taxes. Like California, it could be almost 13% on business sales. But if you're in the state of Texas, zero, nada. It's a little known secret out there. California has very high tax rates, and Texas has none. Yeah, we have property tax, but we don't have state income tax. So there wouldn't be a tax on this business sale if you were selling your business in Texas. So keep those things in mind. Now, if you are making a lot of money and your modified adjusted gross income is more than $250,000 if you're married filing jointly, or $200,000 if you're single, there's an additional 3.8% of net investment income tax. Ouch. IRS just hit you with an extra tax on top of your regular income tax because you made excess money. Hey, remember when you said, hey, vote, let's tax the rich, and you just sold your business and now you're part of that considered rich? Yeah, it happens. We've seen it many, many times in talking with clients and people that, hey, we want to tax the rich, tax the rich, tax the rich, tax those business owners. They need to pay more money. They need to pay their fair share. Well, you just hit what they're talking about, that fair share, that extra 3.8% in net investment income tax. And it's a 3.8% right out of your pocket, my friend, your pocket. Didn't feel really good today, does it? So we're going to talk about ways of mitigating this tax and the tax strategies you can use to mitigate those taxes well when we come right back. Or maybe we won't come right back. Maybe we'll just stay here and keep talking. So we're talking about mitigating those tax strategies and helping you to reduce those taxes. Billy had a great question here. When you buy a company, are you buying the IRS issues it may have? If you're buying the shares of the company, absolutely, Billy. And that's why we suggest when you're buying a business that if you're going to buy the shares, do a tax analysis on it. We can do an 8821 where we can pull all the records and make sure there's no tax liabilities on the business. We also look at the tax returns and make sure that there was no problems on those tax returns to the best of the ability. You may put in a few clauses with that owner that if any other liabilities come up, that they're responsible for them as well. So it's a couple of the issues we can look at as we're going through and doing this. Well, we're going to try to take a short break right here, and we'll be right back, and we'll continue talking about mitigating some taxes and strategies we can use. We'll do that right after this. Well, that was a good break.
Sorry, there was a technical difficulty and we got booted. But you are good. So,
all right, so we're going to continue talking about now executing and minimizing tax strategies and stuff. How can we do that when you're selling a business? One of the ways that you can do that is by doing an installment sale. Section 453, where you're going to spread your payments out on this business over multiple tax years. You're only going to pay taxes on the principal as you receive it, keeping it out of the highest tax bracket. So, you sold that business for $1 million, but you're going to take this in installments, maybe $200,000 a year over the next, 5 years plus interest. So your interest would have ordinary income, and then what you're collecting for principal would then be taxed, less any depreciable assets or goodwill and stuff like that that you're being able to deduct out there. So it is one way of being able to do that. And it spreads it out over, the 5 years or whatever the time period is that you're collecting money from the clients or your buyers, and you're keeping a little bit more of the money, but you don't have full use of all the money today from the sale of the business. You'll be getting a certain amount of money, every year. So you want to make sure that whatever you're doing in that regards, that you've completely vetted the buyers and that they can afford to make sure they're making the payments. We've even seen deals where they're structured that they get a percentage of revenue over the next 5 years, so that they're getting money every single month based on the amount of revenues that are collected out there. So, you may have a deal structure where you get a lump sum up front and then a percentage of the revenues every single year as it's collected. A lot of times you don't want to be on the net income side of it, because they have the ability to modify net income by doing such things as paying unreasonable expenses or paying higher salaries, to where it leaves net of very low income, and therefore you're not collecting as much money each year based on the fact that they can modify that net income as a percentage as you're going there. So you definitely want a certain amount going in, or a percentage of revenues. A lot of times we've seen the deal where the revenues stream isn't guaranteed, and they want you to be somewhat involved in the business continuing this revenue stream. So they'll do it on a percentage of revenues going forward with a lump sum up front. And if you're good with something like that, then you've spread out your income over a period of time that you're going to collect off those net revenues. Now, if you are a C corporation and you qualify under the Qualified Small Business Stock guidelines, you could be eligible to exclude up to 10 million or 10 times your basis, completely free of federal tax. Now, to get to that 10 million, you'd have to have $1 million basis in the company, and therefore that's where you would be. But you could potentially exclude it using Section 1202, which again is that Qualified Small Business stock. Another thing is you can reinvest your business sale capital gains into a designated IRS Opportunity Zone fund to defer federal tax liabilities that are out there. It's the qualified opportunity zones that get you out there and do it. You've got to be very particular in doing this and making sure that you have it set up the right way, so that you don't violate any of the federal laws in doing that in your opportunity zones that are there. One thing that I tell you to do when you're selling your business, make sure you dot your I's and cross your T's. Making sure that what your tax liability is going to be, make sure that you have the money set aside to pay that tax liability. You don't want to be in a position where you have tax liabilities you can't afford to pay, that maybe you've reinvested all the money into a new business out there. If maybe part of that sale is a sale of like a business building. You could possibly execute a 1031 exchange on the sale of the building out there to defer that tax liability out to the future. So there are possibilities of, selling real estate, fixed asset, such as that, building, property, and so forth, that you could execute into a 1031 exchange and defer that profit, future down the road. If you're going to do a 1031 exchange, then you make sure you have a 1031 exchange company and the money never touches your pockets, your bank accounts. It goes directly to the 1031 exchange company and goes directly from the 1031 exchange company to the new investment that you have. You could even use things as Delaware Service Trusts that you can invest in if you don't have particular real estate that you want to get into today. So there's different things that you can do that can, work to your advantage when you're going out there and selling your business or your property that you need to sell. So some of the things that you need to consider and you're going through. Hey, guess what? We're going to take a quick break, but when we come back from this quick break, what we're going to do is talk about what happens when you don't pay the IRS out of this money when it comes due at tax time. We'll do that right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Talking about selling your business, and now you have implications out there on your side of the taxes. Don't expect a settlement with the IRS if you end up with a bunch of tax debt and you spent the money on frivolous things or other things or invested in another business. IRS is going to look at it and go, you have the money you can afford to pay. You just took our money and invested it somewhere else or spent it other places. The IRS doesn't take kindly to that. So, when you sold your business and you're talking to your tax professional, make sure that you set the money aside. Make sure you still met your quarterly estimated tax payments that were required by law. And then, forward the money either to the IRS, put it in an investment account, earn some interest on it, and then make sure you have it there to pay April 15th. If you're going to have $200,000, $300,000 tax debt out of the $1 million you got from your business, then, that liability right there is going to come due on April 15th. And now maybe you've done things to mitigate, your liability. Maybe you've put more money into 401k and you set more money aside, out of this profit from the business. Maybe you've sold property, did 1031 exchange. So all those things that you've done can limit your liabilities with the IRS. But, if you don't have the money come April 15th to pay, the penalties and interest are going to accrue on that money. And then they're going to come looking for the money. So, be prepared to set up that installment agreement as soon as possible if that is the case. Or maybe somebody embezzled money from you, and then make sure you get a judgment against them and issue them a 1099, and then you can write off that as a business expense as well. So, whatever the case may be, you want to make sure that, you're dotting your I's, crossing your T's, and getting things in place from this business sale. And you want to make sure that everything is structured correctly as possible. So, what we are sitting down and talking about is, the tax side of it. Now, get your lawyer involved and make sure that it's structured properly as well from a legal standpoint, because, you don't want the liabilities of, how it's structured as well. This is really important if you're buying the shares of the business, because you're also picking up what is considered to be the liabilities of the business as well. So, you got to be very particular how you structure business sales and the sale of your business. And as a buyer, you want to be very particular how it's structured when you're buying the business. Your assets, the liabilities. What am I getting in this practice? So we were sitting down doing an analysis for one of our clients, and we were looking at earnings before income tax. Weren't really strong, and it was a 2-company deal. The first company we looked at was a little bit better than the second company, but we didn't even have what was the asking price that they were wanting for the business. They just wanted an offer. Well, hard to make an offer when you don't know what they want. Are you just going to offer $5? What are you going to offer to purchase this business? Now, this business can be worth quite a bit of money. They had quite a bit of assets, but they were wanting to do a stock sale, not an asset sale. So, the company, if you divided it up and chopped it up and sold off the trucks and sold off the buildings, and you sold off this and you sold off that of it, would be worth a lot more than buying the stock of the company. Because what? Depreciation value. So, you're buying the vehicles, and let's just say, they had 20 vehicles and you set it at $500,000 on these vehicles. Those are depreciable assets for your new business venture you're starting. You bought this building for, let's say, $1 million. Well, it is now a depreciable asset, and you're getting the advantage of the depreciation. Now, what's the company name worth? Is the company name worth spending that kind of money? So $1.5 million, you buy the stock of the company, you have no depreciable assets because all the assets are fully depreciated, except for maybe the building. And so now, you're getting that little bit of depreciation from the building that you bought, but the other assets aren't going to be depreciated at the same level. And then, what do they have the building on the books for? So maybe they have the building on the books for $250,000, but the building's worth $1 million. You lost that depreciation on the difference out there. You have shares versus the other. So, you got to watch that business structure as well. Now, that can lead to tax consequences on you as the buyer. Because you had less depreciation, you're going to have potentially more net income from the business if you continue to conduct the business, the correct way and increase maybe revenues and stuff out there. You don't have that same depreciated value that you can take as you're building this business. So you got to be prepared to pay the additional potential future taxes out there as well. So, when we're talking about this, it's not just talking about it from the seller standpoint. We're going to talk about it. We talk about it as from the buyer standpoint as well, and how you can best save money. A lot to consider in business purchases, lots to consider in business sales, and we just scratched the surface of things that you need to consider out there as a business seller and a business buyer. Other things to be looking at. If you're a business seller, should I use a broker? Can I do this myself? Sometimes the advantage of using the broker is that you can keep the identity of the business quiet. So that people don't know that you're selling the business until you get closer to having the sale. And you can continue to conduct business in the best interest of the business without somebody looking over your shoulder. He's getting out anyway, or she's getting out anyway, or this isn't going to be the same. People look at these things and they read these things. When you're using a broker, sometimes this is private and quiet and not something that's out there that's for the general population. And then it is on a non-disclosure agreement so that the buyer is not disclosing who's talking and what they're doing. Other times, the sale is out there and it's absolutely public. Your staff knows, and they bought into it and they understand what's going on and the reasons for it. And they're going to help you find the best person for the company and them as well. So they've bought into this sale, and everything is going to continue to run smoothly for the business and for you. Wow, time flies when we're having fun. We this morning at 9:00 Eastern time, we did Ask the Experts right here in W4CY Radio, and talking about IRS problems and solving those IRS problems. Here today on Tax Talk for You, we're talking about selling your business or buying somebody's business and the tax implications in that, and what some of the things you've got to consider. And, some of the ways that you can do it and best ways of structuring the deal from both the buyer and the seller's perspective out there. Last week, we also talked here on Tax Talk for You about starting a new business. So you can go from starting a new business and growing that business to a great big business, something somebody values. And maybe you're ready to retire, ready to move on. Maybe you're ready for a new challenge and you get to the point where you want to sell your business. And that's what we were talking about here. So it's great things when life happens and goes down the road and you've been successful in your business and making money. And it comes time to move on to that next challenge in life, whether it's selling the business, opening another business, or just maybe you're out there and not wanting to sell the business, maybe bring on new partners. And how do you value the business as well? It's kind of the same steps you go through, but you add in, hey, what is this partner bringing to this deal? And they buy into the partnership. They pay for part of your interest in the business to join you and go forward. And sometimes that's a great way of slowly selling the business or grooming somebody in the business, but you got to make sure it's the right partner, right fit as well. And we're right here on Tax Talk for You. We're here every Mondays at 10 a.m. Eastern time. If I'm here, you should be here. And if you do miss one, go to taxtalk4u.com or go over to Facebook and find us there, or even on YouTube, and follow us so that you never miss a episode of Tax Talk for You. And remember, if you got tax problems, go to taxationsolutions.net. Let Taxation Solutions solve your tax problems and put them to bed once and for all. If you're owner, operator, truck driver, go to truckertaxtools.com. Get over there for bookkeeping and tax help for your trucking company. Love to be of assistance for you in your business and helping you keep the truck on the road and not have to owe the IRS the maximum amount, but get it down to the minimum amount owed by law. Hey, we have a lot of fun here every Monday at 10 a.m. Eastern time on W4CY Radio. You got to be here with us. You get to learn new things and ask the questions to help save you and your business money. Whether you're buying a business, whether you're selling a business, whether you're starting a business, whether you owe the IRS, whatever it may be. If you got a question about it, we're here to answer your questions. So be here every Monday at 10 a.m. Eastern time on W4CY Radio and Tax Talk, the number 4 letter U.com. Be here. Have a very God-blessed and glorious week. Enjoy what you do, but be here every Monday at 10 a.m. Eastern Time, W4CY Radio. We will see you soon. See you next week. Have your questions ready and be here. Take care. Have a God-blessed week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at TaxTalkForYou.com. See you next week at W4CY.com.